more than 30%.
Welcome back to the Shelby podcast show. I'm excited about today's show because we're going to talk about finance. In our today's society, economy is very uncertainty. The interest rate is high. The job unemployment is going up and down. So finance and saving for retirement and have financial freedom is so important. And myself, I got into the interest and passion about learning finance during COVID time, reading books. But today, I have a colleague and a financial professional here on the show. His name is Juan Santos. Juan, welcome to the show.
Hi, thank you so much, Shelby, for having me here today. I'm really excited to share a few tips about financial literacy and education for the community to learn more about what we do in our financial literacy campaign.
Okay, great. So to start off, let's introduce yourself. Tell the audience a little bit about yourself.
So, once again, I am Juan Santos, and I am from Gardena, California, which is in Los Angeles County. And I lived there until I joined the military right after high school. And after the military, I went through a few different career paths and until I found my passion in the financial industry. Since then, I've been really educating families and helping them reach their goals. So it's really something that I'm passionate about.
Okay, so when did you, like I mentioned, I kind of developed this interest and passion towards learning personal finance during COVID. Is there a time that triggered you or some sort of event occurred to want you to go into this industry?
Not just once I saw the opportunity to start my business in the financial industry, I
Uh-huh.
just really fell in love with the concept of educating families, helping
Okay.
them reach their goals, helping them start an emergency fund. So it's
Mm-hmm.
all great stuff that I do for families. So
Okay.
really, the passion came right after I saw the opportunity.
Okay, great. So what is financial literacy? What does it mean? Like, because maybe many audience probably don't know what that is because it doesn't teach us in the school, right?
Right. When we're going through school, starting in grade school, North
Uh-huh.
America, we don't teach financial literacy or anything financial in schools. Financial literacy is learning all areas of finance, anything from college savings to retirement, all areas of life insurance. Just learning financial literacy is very important. So many people go 40 years working and then never grasping the financial education they need, such
Mm-hmm.
as overcoming taxes, overcoming inflation. These are
Right.
all areas that nobody really plans for, but the financial literacy helps overcome those obstacles so that people can retire better.
Yeah, because also a lot of people are living paycheck to paycheck, and especially in our economy today,
Right.
there's many people maybe lost their job, got laid off,
Hmm.
and they cannot survive, or even during COVID. I when I start having the passion, I did came across this called emergency fund. So, what's your take on emergency fund? Like, what people who should need it?
So,
Yeah.
emergency fund is something that everybody needs. When COVID started, so many people were laid off, so many people were let go from their jobs, so many people faced an emergency. Not having an emergency fund is actually an emergency in itself. If you don't have at least 6 months of an emergency fund in place, covering your income, covering your expenses, that's going to really impact you. So, when somebody doesn't have an emergency fund, everything becomes more of an emergency in itself. It
Right.
requires people to go out and get credit cards, or if they already have them, chances are they're going to max them out. They're going to
Right.
put a lot of money that should have been there in the first place in their
Hmm.
emergency fund, but instead of doing so, they're using credit cards to get through that tough time.
Right. Okay. So, before we go to the next question, I want to put out a disclaimer. Even though this is about finance, but we're not telling you what to invest, what to do. It's more like a information, entertainment purpose. So everyone's situation is different. So you might want to consult with your own financial advisor. And if you do have question of what we're talking about here, you can reach out to Juan or reach out to me, and we can maybe do a Zoom call, free Zoom call.
Mhm.
Yeah. So you mentioned about credit card max out. So I personally did max out my credit card in the past,
Mhm.
and it's very stressful and very headache. So I know you have a program that can help family. What is it called? Like towards the credit card debt and
So one strategy that we use for people to get out of debt is actually called a debt roll up. What that means is that you start typically with your debt that you owe the least. For example, let's say you owe $180 on a credit card. You're going to tackle that credit first by putting an extra $100 on top of what you're putting in for your minimum payment. So that intensifies and makes the credit card get paid faster.
okay,
Once you finish the first one, then you move to the second
right.
highest um, credit card debt, for example.
Uh-huh.
So you go um, one by one until you reach the top, and at
Okay.
that point, you can get out of debt quicker.
So I also learn from other YouTube creators. They also have this advice, like, because credit card gives you points and incentive. It's kind of attractive. So if people really need to use it or want to take that advantage, do you have any? Because what I learned is you don't use the credit card that you don't have or for or be able to pay
Hmm.
for it, right, on the same
Correct.
month.
Right. So typically, you want to use no more than 30% of your credit limit. And this is very important, especially if you're going to purchase a home. But you
Okay.
don't want to max out your credit cards. You definitely want to avoid that. The more debt you have, the more interest you're going to pay over the years.
Okay.
And that's going to really put a damper on your credit for the future. So if you were to want to buy a home, it's
Hmm.
going to limit what you can potentially get.
Right.
Because when you're purchasing a home, you're going through underwriting and you're going through the loan process. You're going to go through what's called debt to income ratio.
Right.
So if your debt
Yes.
to income ratio is really high, they're going to probably either give you a high interest rate or you may not qualify for the loan at all. So you definitely want to keep it no more than 30%.
Right, and it will affect your credit score, and also, it's not a fun thing to do. Like I mentioned, have you ever had this problem before you're even in the involved in this industry personally? Have you ever
Oh,
like maxed out?
yes, definitely. Life happens.
Right.
When situations arise, we're not prepared for them. Life
Mhm.
doesn't give us a head start saying, hey, in 6 months, you're going to experience this adversity. That's why it's important to always plan ahead, always have that emergency fund. So, yes, there was a point in time in my life where I had a lot of credit cards.
Mhm.
I maxed them out. So, once I maxed them out, even though I had everything I needed, at that point, money was still tight because
Yes.
the emergency fund was not in place. So it
Right.
was a very challenging time. But
Uh-huh.
with the financial literacy I've learned, been very, very effective for me to be able
Right.
to move forward when those times come. Because
Mhm.
I already have everything in place
Right.
the way I should have had before. But you live and you learn. And with the financial literacy, we can
Yeah.
definitely help you get to where you want to go.
Yeah, and in one of my other shows episode, I mentioned pay yourself first,
Yes.
and that's part of the financial literacy, financial freedom.
Mhm.
What does it mean? Because I kind of did a demonstration from what I learned, but
Yes.
what does it mean to you, to your profession about pay yourself first?
So when you put yourself first, you're telling yourself that you're going to be the one that's going to accomplish your goals in the long run. The person who gets paid first gets the
Mm,
wealthiest first. If
correct.
you're paying all your bills, all your debt, all your expenses up front, it's a good thing. But when you pay yourself first, it becomes a more effective strategy for your
Right.
future because as you pay yourself first, you budget better in regards to things like cable,
Hmm.
expenses, things that you want to go do and have fun. If you max those out, you're going to leave yourself a little bit of room
Right.
to be able to save for your future. So it's very important that when you start saving, you pay yourself first. You want to
Right.
pay yourself at least 10%, if not 15 if you're able to.
Right.
If you pay yourself last, you're going to limit what's going to be there for your future.
Hmm.
So that's why it's important, definitely, to pay yourself first, at least
Okay.
10%.
Yeah. So by paying yourself first, I personally is like putting in investment. So investment, we all know diverse,
Hmm.
diverse your money. So I did have stock, I did have IRA and
Yeah,
crypto and all that. But when it comes to another like your profession is people can also diverse and pay yourself through life insurance. Is that
correct.
correct? Can you kind of explain or tell us what's that about?
Yes, absolutely. So when you're starting your financial portfolio, you definitely want to diversify your assets. You don't
Right.
want to put everything in one basket.
Yeah.
The first part of the financial foundation that we teach our clients is you want to definitely always start with proper protection.
Mhm.
This is in case you need to stop working, if you're experiencing adversity like a bad injury,
Right.
like a bad illness. You definitely want to start with proper protection at the bottom, which is
Mhm.
the most important thing. If you don't, then what happens is your financial foundation is not going to be very strong. So
Right.
once you establish your proper protection, then
Uh-huh.
you move on to tackling your debt management. You
Okay.
don't want to ignore one or the other before, but you definitely start with the proper protection. After you handle your debt management
Right.
effectively, then you can start working on your emergency fund. Once the
Mhm.
emergency fund is in place, number one, you have the proper protection in case you need to stop working, but you also have the emergency fund in case you need it for additional purposes. These are things like if you experience a vehicle breakdown, just the engine itself
Mhm.
can cost you anywhere from two, three, $4,000.
Right.
When you don't have an emergency fund in place for those types of things
Yeah.
and you use credit, that's gonna really put you in a bad spot long term.
Right.
So once you have proper protection, followed by debt management, then
Mhm.
emergency fund, finally you want to look into saving and investing. So
Mhm.
by this method, you're going to be able to establish a proper foundation
Right.
for your future that's effective. And if worst case scenario something happens where you need to stop working, you
Uh-huh.
have the emergency fund, you have the proper protection in place, so you're not
Mhm.
going to worry when those times come.
Okay. So, for many people's understanding, like life insurance is it about like about death, right?
Correct.
And so, young people, which like let's say 20s or even early 30s, they're not gonna think about death. I need to buy a life insurance,
Hmm.
right? So, what's the difference between let's say I'm in my mid 40 and to buy life insurance is, versus the 20-year-old to
Right.
buy. What's the benefit? What's the difference?
So when it comes to life insurance, many people think that it's only a death benefit for
Right.
the beneficiaries that are listed to have in place when something bad happens. Sometimes people don't realize that there's so many areas of life insurance that can really help tremendously. For somebody that's young, life insurance can be a great way to start your financial portfolio.
Mhm.
There's a way that you can save money within a policy. This is called Index Universal Life. And what's powerful about this is that, contrary to what people think, it's a great way to save your money. You
Mhm.
don't pay taxes when you pull it out at a certain amount.
Mhm.
You have stability in the policy. You have what's called a guarantee. So
Okay.
when you save the money, you're guaranteed that you're never going to go below 0%.
Right.
So that means that you lose zero in the policy.
Okay, so let me throw you a scenario.
Mhm.
Let's say if I had that policy, life insurance, universal one. Let's say if I got laid off or my business is not doing so well, like these days,
Mhm.
many people in this kind of situation, can I borrow from that policy even I'm still alive?
Yes, that is correct. So one portion of the life insurance itself is the protection itself. The other portion is a savings. It's called cash value. So when you have cash value in the policy and you're able to withdraw it, you can withdraw it tax free, up to 90% of the amount that's in there. So what's great about it is if you don't have the means to pay for it, your policy is going to remain in force. But what happens is you can either pay the minimum at that point, or if you say to the company you want to start skipping some payments, you
Uh-huh.
can do so. And at that point, when you skip those payments in an index universal life, the payment comes off of your cash value savings. So it's a great way to always have proper protection. And if you need to stop working, or if the business
Right.
that you're operating is very slow, you don't have to worry about that policy lapsing if there's cash value in it.
Okay. And is there a penalty?
No, there's no penalty involved. So the only penalty that is involved is if you take out more than 90% of
Okay.
what's in the cash value. At that point, you will get taxed. But
Mm-hmm.
anything below 90%, you don't have to worry about paying taxes when you withdraw.
Okay, great. That's a very good information. See, you don't have to use credit card. You don't have to
Right.
get a loan to pay interest. So my next question is, so sounds like life insurance is not really just about death benefit, right? People can withdraw. And what if, let's say, for example, if someone wants to have like their kids or their newborns, can the newborn buy the policy when they're still a baby?
Yeah. So as soon as the child gets a social security card
Right.
in the mail, they can get a policy for their children.
Okay.
So what's great about this, it's a great way to get their insurability at a very young age.
Mhm.
Once you have this insurability, they don't have to worry about getting a policy if they experience any kind of illness when they're adults.
Okay.
However, when it comes to children, later on you want to add additional features to it.
Right.
So when they become adults themselves, you want to make sure that you can assess the policy itself
Right.
to add features like long-term care,
Mhm.
to add a feature like critical illness, chronic
Yes.
illness, terminal illness.
Right.
These are all things that are not available to children's
Children.
policies,
Right.
but it's a great way to get them insured at a very young age. And as you grow the policy at a very young age, let's say at 3 weeks, you get a policy for the children, you
Mhm.
can use that money for anything like getting their first semester of college started.
Oh,
You can use
okay.
it for purchasing
Good.
their first vehicle. Things
Yes.
that are going to help them through their adulthood, you can
Right.
purchase it. What's great is, contrary to what people believe, you can grow the money in a policy tax free.
And the younger a person starts, the better, right? Compounding effect.
Correct. So one great thing about the index universal life, the policy is going to compound. The
Mhm.
more you keep the policy in place, the better. The younger you start, the better it is for the long term. Mhm.
So I heard this, like, let's say if I start in my 20s and if I stop paying, let's say 35,
Mhm.
well, it will pay itself, right?
Correct. So if you keep it for a very long time,
Uh,
you could eventually stop paying the policy itself.
hmm.
At that point, every year when there's growth within the policy, the money's going to compound. So even though you're not making payments anymore, you're going to keep growing the money little by little.
Right.
You will eventually potentially come to a point where even though you're not paying the policy anymore,
Uh-huh.
the money's going to compound and you're still going to have growth in the policy. So once you reach 65, if that's your goal to retire, you can still have a good amount of money within the policy. The more you pay into it, the more that the policy is going to grow.
Okay, great.
Yes,
So now you mentioned retire. I have a lot of questions because um, retirement, Social Security is to me, from what I've been reading and hearing, Social Security might not be available for us or millennials later on,
correct.
or the boomer who has 401k or even pension might not be getting them.
Mhm.
So, what's the best way to have retirement? What's the best plan that people can start doing today? To
There's generally no specific plan for a person. It really depends on their goals. It
Okay.
depends on their age. It depends on the income that they're making. It depends on their family size. Because when you have a financial foundation,
Hmm.
as I mentioned, you want to
Yeah.
start with proper protection.
Right.
So the more um, expenses, the more debt that's in the on the table. These are things that are going to impact the financial foundation.
Mhm.
Therefore, when you want to start your retirement plan,
Right.
you want to diversify it. Number one,
Okay.
you want to make sure that you're covering all the bases before you start the savings process.
Okay.
However, when you start your financial foundation at the point where you're going to start saving now, you want to make sure that number one, you're going to minimize the amount of taxes you're going to pay.
Uh-huh.
You're going to minimize the risk. So you don't want to put your money somewhere where it's aggressive. The more aggressive you get, the higher chance that
Right.
you're going to lose some of the money. So one thing that you want to make sure you're covering is learning how to overcome inflation,
Mhm.
minimizing
Right.
taxes, and minimizing the risk.
Yes.
Through the financial courses that we teach in the workshops, we're going to cover all those things.
Okay.
So once you learn about tax now, tax later, and tax advantages, those
Mhm.
are the three ways that you're going to assess where you're going to put your money. Where you put your money matters. The
Yeah.
more taxes you pay, the long term, the less money you're going to potentially have when it comes
Right.
time to withdraw at retirement.
Earlier, you mentioned that you're veterans, and from what I seen, I have a lot of friends who also are veterans,
Mhm.
and personally, I kind of feel um, those people, those friends, those people who serve in our country,
Mhm.
they don't get take care of from our own country. That's
Yes.
reality. So a lot of those veterans end up either homeless or not very in a good, healthy, good living condition.
Mhm.
So I know you help a lot of veterans community. So with this life insurance saving program, how can it be benefit for the veterans, or what type of program you have helped them before?
So, as a veteran myself,
Yeah.
one thing that we're offered when we start our military career is what's called a thrift savings plan,
Mm.
TSP.
Okay.
That's
TSP.
the financial 401k that's offered to military.
Oh, I didn't
So,
know that.
once a person separates from the military,
Uh-huh.
they have a TSP. So, at that point, they need to roll it over into a SEP IRA if they become a
So,
business owner.
okay.
They need to roll it over into an individual retirement account
Mm-hmm.
if they want to continue either growing the money or if they want to have a personal account. At that point, when they roll it over, they'll have different options depending on their goals and, you know, what they're looking to do. Generally, when a military person retires, they're not very um, old yet. Chances are they're probably 40, 45.
Mm-hmm.
So they're still going to go into the workforce.
Right.
However, they need to roll over that retirement account. So once it comes time for us doing an assessment with them, we have them bring a statement and we assess what their goals are. If they have a business, then, like I mentioned earlier, you want to do a SEP IRA, which is a self employed
Right.
individual retirement account. This not only is a great option for a business owner, but
Mm-hmm.
it also has potential tax breaks and tax advantages if it's properly um, handled the right way. So through the assessment, we're going to determine if there's a tax write-off, if there's a tax break,
Mm-hmm.
or what tax advantages are out there at that point, so they can potentially have great tax advantages.
So if they don't roll over, what happened? Did they just lose it?
No, what happens is if they don't roll it over, it's gonna keep performing the way the military makes it perform.
Oh,
It's very
okay.
important because at that point, you really don't have a lot of control about
Right.
what's happening.
Yeah.
However, when you roll it over into an IRA, into a SEP IRA if you're a business owner,
Uh-huh.
these are all areas where you have a little bit more control as to what you can do. Because now that you're more in control versus the thrift savings plan company is in control instead of you.
Okay.
Mhm.
And can those be also roll over to buy a home or no?
It depends. Typically, if you want to pull some money out of a retirement account,
Uh-huh.
they generally let you only take out $10,000.
$10,000.
Yes, that's generally the rule.
Okay.
However, if you have a different way of purchasing a home, it's
Mhm.
always great to explore those options.
Right.
Not that taking out that $10,000 from your retirement account is a bad thing. However, you're limiting the amount of money you'll have for retirement. So you
Mhm.
always want to explore alternatives
Options. Right.
before that potential $10,000 withdrawal comes into play.
Yeah.
It's a good option if there's no other alternatives, but you limit what's going to be there for retirement,
Yeah, because more veteran can have 100% mortgage
right?
instead of in general 20 or 20 below percent.
Yes.
Yeah. So that's a lot of information. So I'm sure a lot of audience or people who watch this show will have a lot of questions. So remember, you can contact Juan or me, and we can do a Zoom call, free Zoom call. And what if? Okay, I'm gonna do another disclaimer. I am already joined Juan's team, and I'm started learning a lot of information, not just from the book I read. And so, if anyone who's listening to this show or watching this show, if they are interested to learn more or even be participate to become like a professional, how can they start?
So the first part is seeing our corporate overview introduction. This is a way where you're going to see samples of our financial literacy and education. So you're actually going to learn great tips on improving your financial future. Secondly, you're going to learn about our company. WFG is part of Transamerica. We're a Transamerica company.
Right,
So therefore, when you see our corporate overview, you're going to learn about our financial literacy campaign of looking to educate 30 million families by the end of
right.
2030. Third, you're going to understand the options of starting a business career with us. So when you attend our corporate overview, it's a great
Mhm.
way to learn about those three things.
And I want to add this one. Let's say if you already heard about WFG or Transamerica, or you've been into a different um, group or hierarchy, every every group, every hierarchy is actually operate different. It's like a franchising. There's of course there's a foundation, but the person who leads is always
Mhm.
different from different group and people, right?
Yes, that's correct. So yeah, all offices are different. They operate in a different fashion. So no
Right.
office is the same. What's great about it is that we have over 300 locations. So it's a great way to explore options if you're looking for a new career or even a part-time career.
Yeah. So we look forward to have you come back. Maybe we can talk about more about finance or insurance, or even help people how to start this business because it's a great opportunity. It's like you owning your own franchise
Yes.
without paying a large fee, right?
Mhm.
So do you have any last thought that you can share with our audience?
No, really, the last thought I have is when you are looking to start a better future for yourself, you want to start right away.
Right.
Financial literacy is a great opportunity for you to do so. The more you wait, the less you'll have in the long run. So it's always a great way to start learning when you're young, definitely.
Yes. Yeah. So thank you for coming to the show. And I'm very happy and I look forward to do more show with you and share the knowledge and information, finance or even business.
Yes.
So thank you again.
All right. Thank you so
And
much.
thank you. We will be seeing you guys again next time. Remember to subscribe, like, share. Thank you.